And you've probably heard of the Federal Reserve, and you've definitely heard of banks like Chase, Bank of America, or Wells Fargo. But did you know they're not the same bank at all? Today, I'll explain the key differences between central banks and commercial banks, how they interact, and why it all matters to you. So, our agenda today is what is a central bank, what is a commercial bank, major differences, how they interact, and why it matters to you. What even is a central bank? Let's start. A central bank is a special financial institution that's in charge of managing a country's money supply, interest rates, and currency. It's not a regular bank. It doesn't offer checking accounts or hand out loans to everyday people. In the US, our central bank is the Federal Reserve, often called the Fed. Other examples include the European Central Bank and the Bank of England. The Fed's key responsibilities include controlling monetary policy, like raising or lowering interest rates, issuing currency, regulating and supervising commercial banks, and acting as a lender of a last resort during a financial crisis. Basically, if the economy were a car, the central bank is the one managing the gas pedal and the brakes. Next, we have what is a commercial bank? Now, let's talk about the ones that we use. A commercial bank is a for profit business that deals directly with the public. These are banks like Chase, Wells Fargo, Bank of America, and Citi. What do? They accept deposits like your paycheck. They offer loans like mortgages, car loans, or business loans. They issue credit and debit cards, and they offer tools like online banking, saving accounts, and checking accounts. Their main goal? To make money. They earn profits mostly by charging interest on loans and collecting fees. Let's break down the core differences between a central bank and a commercial bank. So, for a central bank, the main purpose is a public economic policy. For a commercial bank, it's profit. For a central bank, their customers are the government and banks. For a commercial bank, it's everyday people and businesses. Central banks create money, but commercial banks, they don't. They multiply money through loans. Central bank is regulated by the government or Congress, while commercial banks are regulated by a central bank. So next is an example. So an example for a central bank could be the Federal Reserve. An example for the commercial bank could be JP Morgan Chase. So while a central bank creates and controls money, commercial banks move money around and earn profits by lending it. Next, we have how they interact. So the central banks regulates commercial bank by setting rules they have to follow, like how much money they must keep in reserve and how much they can lend out. It also sets the federal funds rate, the base interest rate at which banks borrow from each other. When the Fed changes this rate, commercial banks adjust their own interest rate for mortgages, savings, and credit cards. So when the Fed raises rates, loans from the commercial banks become more expensive, and when the Fed lowers rates, borrowing gets cheaper. You might be thinking, why should I care? Well, here's why. The central bank influences how much interest you pay on loans, affects how much you earn on savings. It helps prevent bank failures and financial collapses. It controls inflation, which impacts how much your money is worth. So whether you're opening a bank account, taking out a student loan, or watching the economy shift, central and commercial banks are behind the scenes making it all happen. So next time you hear about the Fed raising rates or a big bank failure, you know exactly who's involved and how it could affect your money. Thanks for watching. If you found this helpful, hit that like button, and subscribe to Finance with Manvi for weekly no fluff, fact-based finance. Thank you, and I'll see you in my next presentation.